Welcome to Business Education and Research. This video presents the risk of having a high degree of financial leverage. Companies with high degree of financial leverage have substantial debt relative to equity, can be at risk of financial distress, and face several potential failures. One of the most immediate and direct risks of high financial leverage is the burden of interest payments. Companies with a substantial debt load must allocate a significant portion of their earnings to service the debt. If the interest payments become unmanageable, it can lead to insolvency, where the company is unable to meet its financial obligations, leading to bankruptcy or liquidation. High debt levels can lead to decrease in profitability. When a significant portion of the company's earnings goes towards servicing debt by way of interest payment, there may be insufficient funds available for the reinvestments in the business, research and development, or other growth initiatives. This can negatively impact the company's competitive positions and future profitability. Companies with high degree of financial leverage may face liquidity problems. If they cannot generate enough cash to meet their debt obligations, they may resort to selling assets or borrowing more, leading to a various cycle of debt accumulation. High debt levels can result in credit rating downgrades. A lower credit rating makes it more expensive to raise additional debt and may lead to a loss of investor and lender confidence. As investors become aware of companies' high debt levels and the associated risk, the stock price can decline as a reflection of market distrust. This can harm the company's market capitalization and may lead to shareholder lawsuits or activist investors' action. Companies with high degree of financial leverage may find themselves constrained in making strategic decisions. They may be unable to pursue certain growth opportunities, make strategic acquisitions, or engage in share buybacks due to their high debt service obligations. Macroeconomic factors can worsen the challenges faced by a highly leveraged companies. Economic downturns, rising interest rates, or currency fluctuations can significantly impact the ability to service debt, especially if revenue and cash flows decline. Highly leveraged companies may lose their competitive edge due to financial pressures. They may be unable to invest in technology, research and development, or marketing to compete effectively in their industry. Examples of Indian companies with high financial leverage failures. Kingfisher Airlines was a prominent example of a company in India that faced financial distress due to high financial leverage. It took a substantial debt to finance its ambitious expansion plan, but struggled to generate sufficient revenues to cover its operational and debt service cost. The airline eventually ceased operations in 2012. IL&FS, Infrastructure Leasing and Financial Service, a major infrastructure financing and construction company in India, had high financial leverage and became embroiled in a financial crisis. It was unable to meet its debt obligations, leading to concerns about the stability of the Indian financial system. The government had to intervene to address the crisis. Essar Steel. Essar Steel is one of the India's largest steel manufacturers, faced a debt crisis that resulted in a protracted legal battles and eventual insolvency proceedings under the Insolvency and Bankruptcy Code (IBC). The high debt levels and the inability to service it significantly affected the company's financial troubles. The failure cases given in the previous slides shows high financial leverage contributed to the downfall of these companies, resulting in financial distress, insolvency, and significant losses for investors, lenders, and other stakeholders. These examples highlight the importance of careful debt management and the need to balance leverage with sustainable growth and profitability in the corporate world.